Okay, so if you clicked on this video, you're probably either a Muslim investor trying to keep your portfolio halal, or you're just someone who's heard that these ethical screens somehow beat the regular market, and you're thinking, wait, how does that work? Either way, you're in the right place. Here's the thing that surprised me when I started looking into Sharia compliant investing. It's not just about following religious guidelines, though obviously that's the main point for Muslim investors. These screens accidentally filter for companies that tend to be more resilient during market chaos, and the numbers back this up. In 2025, the S&P 500 Shariah Index returned 18.6%. The regular S&P 500, 17.9%. So the restricted portfolio that excludes entire sectors actually outperformed the unrestricted one.
Damn.
Which seems backwards until you understand what these screens are actually filtering for. Let me explain the secret sauce here. When you exclude companies based on Sharia criteria, you're basically cutting out high debt companies and traditional banks. What you're left with is a portfolio naturally tilted toward high quality businesses with strong balance sheets. And when interest rates go up, which they did throughout 2024 and into 2025, companies drowning in debt get crushed, but companies with low debt, they're fine. They just keep doing their thing. This is why non-Muslim investors have started paying attention to these screens. It's like accidentally creating black swan insurance by just following religious guidelines. Companies with low debt-to-equity ratios are statistically less likely to go bankrupt when the Fed decides to mess with rates again, which they will because that's basically their entire job description at this point. Now let's talk about the actual screening criteria, because this is where it gets specific. Most apps, Zoya, Musaffa, and Islamicly, use something called the AAOIFI standards. Think of these as the gatekeepers. First, there's the business screen. No alcohol, tobacco, gambling, conventional banking, or adult entertainment. Pretty straightforward. If the company makes money from stuff that's haram, it's out. But the interesting part is the financial screen, because this is where the anti-fragile magic happens. There are three main ratios, and all of them have to be under 33%. 1. Debt divided by market cap, averaged over 36 months, must be less than 33%. 2. Cash plus interest-bearing securities divided by market cap must be less than 33%. 3. Accounts receivable divided by total assets must be less than 33%. That second one trips people up. You'd think having lots of cash is good, right? But if a company is sitting on a mountain of cash and earning interest on it, that's technically problematic from a Sharia perspective. And from a business perspective, it often means management doesn't know what to do with the money, which is its own red flag. Alright, so let's get to the actual picks for February 2026. I'm giving you 5 stocks that pass the Sharia screens and also happen to look undervalued based on discounted cash flow models. First up, Uber, trading in the 70s of dollars, but the DCF model puts intrinsic value at around $148. Now, before you say that's literally double, remember that DCF models can be wildly optimistic. But here's why Uber's interesting. It's the dominant player in ride-sharing and food delivery. It has an asset-light business model. They don't own the cars. And they're actually profitable now with increasing cash flow. Plus, they're well-positioned for the driverless car transition whenever that actually happens, which might be next year or might be in 2035. Honestly, nobody knows. Second, Visa, trading around $330, depending on the day. Intrinsic value somewhere around $412 to $422. Visa has operating margins around 60%, which is honestly insane. For every dollar of revenue Visa earns, about 60 cents is operating profit. And they're expected to keep growing at double digits through 2030 because, the world is going cashless whether we like it or not. Third, Eli Lilly. This one's sometimes trading at about $1,010 and sometimes over $1,100 per share. It's been on a bit of a roller coaster ride these past few days after earnings for sure, but the DCF model says it should be $1,600. Yes, it's expensive on a forward PE basis, like the most expensive on this list, but they're spending 25 to 38% of revenue on R&D, which is massive, and their return on invested capital keeps going up. They're basically the pharmaceutical company actually investing in future drugs instead of just milking old patents. Plus, the whole obesity drug market is exploding right now. Fourth, automatic data processing, or ADP, trading around $215. Analysts see 11 to 14% upside to around $265 or higher. This is the boring one on the list, which is kind of the point. They process payroll. That's it. But they're a dividend aristocrat with excellent free cash flow, dividend yield close to 3% right now, 9% earnings growth, and they're actually buying back shares, so your ownership percentage keeps increasing. Sometimes boring is beautiful. And fifth, Nvidia. Still in the 180s after all the volatility, DCF model puts it at $226. Look, I know everyone's talking about whether AI is overhyped or whatever, but Nvidia is still the backbone of AI infrastructure. They're selling the shovels and the pickaxes. They have high margins, low debt, and every big tech company, gaming enthusiast, and crypto miner are throwing money at them for GPUs. The cash flow estimates keep getting upgraded because the demand is genuinely massive. Now, I know what you're thinking. What about Meta, Microsoft, Google, Pinterest? And yeah, those are all good companies with increasing revenues. But if you check the Zoya app in February 2026, they're showing up as questionable. The compliance status isn't clear-cut, usually because of interest-bearing cash mountains or mixed revenue streams where part of the business might be in a gray area. And here's the thing. For Muslims especially, but really for anyone trying to invest ethically, the questionable ones just aren't worth the stress. Like rizq, sustenance, has been written by Allah. We do our due diligence, we put in the work, but ultimately we leave the results to God. A few important notes before we wrap up. Analysts recommend adding a 5 to 15% margin of safety to these intrinsic values because of market volatility and geopolitical uncertainty, which is always a thing. These valuations come from DCF models and historical multiples, not from me pulling numbers out of thin air. And some stocks like Pinterest are trading near 52-week lows right now due to market sentiment, which could be opportunities for long-term investors, but they've got compliance questions, so I'm leaving them out of this list. The bottom line is this. Sharia compliant investing isn't just about following religious rules. The filters happen to select for companies with strong fundamentals, low debt, and sustainable business models. And in 2025, that approach beat the benchmark. Will it work in 2026? Nobody knows. But the underlying logic makes sense, and the stocks I've listed today are trading below their estimated intrinsic values while passing the compliance screens and are companies that actually provide value. Do your own research, check the current compliance status on apps like Zoya or Musaffa because things change, and invest according to your own risk tolerance. And may Allah put barakah in whatever you choose to do with your money.